I have the CME Group Delivery Report in front of me, and instead of speculation, let's start with the data. Because data removes emotion from the conversation. The exchange issued 1,168 delivery notices in a single session. Each notice represents 5,000 ounces of silver, which means 5.84 million ounces were demanded for physical delivery in one day. Now zoom out just 48 hours. When we combine this session with the spike recorded on New Year's Day, the total number of contracts standing for delivery reaches 3,446. That is not a typo. 3,446 contracts multiplied by 5,000 ounces, each equal 17.23 million ounces of physical silver moved in 2 days. To understand the scale, global silver mining produces roughly 800 million ounces per year. What happened here represents about 2% of annual global production, pulled forward into 48 hours before most institutional desks were fully staffed for the year. This is not routine commercial hedging. This is not industrial demand smoothing. No factory suddenly orders 17 million ounces on a holiday week. This is structural stress. What we are witnessing is not a trade. It is a transfer of inventory. In this multi-part analysis, we are going to examine this event the way professionals do, by auditing issuer and stopper data, tracing inventory flows, and connecting this delivery surge to the timing of the newly enacted Chinese export restrictions. We will also examine the downstream impact where retail dealers are now reporting extended shortages and delayed availability into March. The quoted futures price may show $72.82s, but the replacement price for physical metal is already meaningfully higher. That gap matters. This event has a name. It is an inventory drain. Now consider the timing. Why January 2nd? Why the first 48 hours of the year? Because this week, China's new silver export controls became legally active. Exports are now restricted to 44 licensed firms, significantly reducing the availability of swing supply from the east. Market participants are not guessing about this. They are reacting to it. Those holding visibility into inventory understand that the 39 million ounces remaining in registered COMEX vaults represent some of the last easily accessible supply at scale. Once those ounces are removed, there is no immediate replacement mechanism. This explains the urgency. Rather than entering slowly, large institutions move decisively, demanding delivery immediately. Nearly half of available registered liquidity was absorbed in 2 sessions. At this pace, the math becomes uncomfortable very quickly. COMEX is not breaking today. But structurally, it cannot sustain prolonged drawdowns of this magnitude without rule changes, settlement adjustments, or intervention. Importantly, this does not present as panic on price charts, because delivery is quiet. Futures trades are loud. Physical settlement happens off-screen. The impact appears later when inventory cannot be replaced. That lag creates asymmetry. The observant investor sees depletion before it is reflected in price. While retail participants debate technical resistance levels, institutional buyers are focused on one thing: possession. Now let's talk about who was involved. Issuer and stopper data reveal something rare: internal stress among institutions that historically functioned cooperatively. On the issuer side, Deutsche Bank delivered a substantial volume, over 3 million ounces in a single day. On the stopper side, JP Morgan and Citigroup collectively absorbed over 4.4 million ounces. This is not routine balance sheet maintenance. It represents a repositioning. Historically, banks circulated metal internally, rolling exposure without removing inventory from the system. That mechanism relies on confidence and surplus. This time, metal moved directionally, from one vault to another, and did not return. That signals fracture. Banks are no longer optimizing collectively. They are securing individually. Now let's examine registered inventory. COMEX reports 2 categories: eligible metal, stored but not for sale, and registered metal, available for delivery. Registered inventory now stands near 39.4 million ounces. In the last 24 hours alone, 2.8 million ounces exited that category. Subtract the metal already demanded, and remaining available supply tightens quickly. At current withdrawal rates, visible registered inventory covers weeks, not months. This explains why futures prices appear restrained while physical premiums rise. Price charts lag inventory realities. Now look downstream. Retail availability reflects this immediately. Major dealers are reporting extended back orders. Some are no longer accepting orders at all. When dealers refuse future orders, it is not greed, it is supply risk. Premiums are expanding because replacement cost is uncertain. Wholesale access has tightened. This is how physical stress transmits. Exchange, vaults, mints, dealers, public. By the time headlines appear, the metal is already gone. Globally, this is not isolated. Shanghai inventory data shows significant withdrawals, coinciding with the same period. Domestic demand in China is absorbing internal stockpiles as export flexibility diminishes. This creates simultaneous drawdowns in East and West. Daily global consumption now exceeds daily mine supply. That imbalance cannot persist indefinitely without repricing. Backwardation, where spot trades above future delivery, confirms urgency. Buyers are prioritizing immediate access over promised supply. This condition historically precedes major repricing events in physical commodities. Now, a critical clarification: this is not about bank insolvency. The financial cost of this metal is immaterial to institutions of this size. What matters is availability, not dollars. Fiat currency is infinite. Physical silver is not. Institutions are converting liquidity into assets, while the conversion rate still favors them. That is the signal. This marks a strategic pivot, away from paper exposure toward physical control. Retail participants should understand the difference between price and access. Charts reflect transactions. Inventories reflect reality. What happens next will not be decided by sentiment, but by supply. The metal is moved, the inventory has changed, the system is adjusting, and once physical scarcity becomes visible, price follows, not the other way around.
Hello my dear friends, welcome back today my new video and my channel. So friend, I have the CME group delivery report in front of me, and instead of the speculation, let's start with the date, because that removes emotion from the conservation. The exchange issue 1168 delivery notice in a single session. Each notice represents 1500 ounces of silver, which means 5.84 million ounces were demand for a physical delivery in one day. Now, zoom out just 48 hours. When we combine this session with the spike record on New Year's Day, the total numbers of contracts standing for delivery reach 3,446. That's not a typo. 300 304,046 contrasts multiplied by 5,000 ounces each equals 17.23 millions ounces of physical silver move in 2 days. To understand this scale, global silver minimum products regularly 800 million ounces per year. What happened here represents about 20% of annual global production, pulled forward into 48 hours before most international discs were fully shuffled for the year. This is not routine commercial herding, this is not industrial demand smoothing, no factory suddenly orders 17 million ounces on a holiday holiday week. Thank you so much.